In this video, we're going to conclude our discussion on bonds by looking at more of the risk factors. What are the risk concepts that impact the value of bonds? So we do know that there is what's referred to as risk premiums, right? There is a series of costs that are attached, premiums. Maturity risk premium, the default risk premium, the liquidity premium, and certainly inflation premium. All of these factors are components of the overall yield for the bond. So we want to discuss some of these factors and how we can utilize this information. So what is the real risk-free rate of return? It really is a hypothetical riskless security that pays each moment if zero inflation were expected. So it's created by the supply and demand of money. It can be approximated by the rate that's on short-term Treasury inflation protected securities, or TIPS. We typically proxy the risk-free rate with United States Treasury securities. So short-term securities, we'd use T-bills. Long-term securities, we would use T-bonds. So it is a difficult thing to actually measure. Again, it's the interaction between supply and demand in the economy. That's kind of hard to narrow down. So how can we estimate the inflation premium? Well, Treasury inflation protected securities, TIPS, are indexed to inflation. So as inflation changes, the par value of these TIPS change. The coupon is a percentage of the par value. So as inflation changes, the coupon changes. Now, the coupon itself, the payment changes, but the percentage is still fixed. So what we can do is look at the relationship between regular Treasury securities. In this case, we have a Treasury security of a 30-year Treasury security is 3.15%. Well, now we need to look at, what is the TIP? What is the inflation-adjusted return on the TIP? Now, if you look at this data, it tells us that that return is actually negative 0.07. So to find the estimated inflation premium, you take the yield on the risk-free rate, and you subtract from that the yield on the Treasury inflation rate, which should represent the real rate. So 3.15 minus 0.07 tells us that at this point in time, on May 5th in 2022, it should have been around 3.85% is the inflation premium on bonds. Now, what's the relationship between the bonds and their yields at different levels of default risk? If you think about what they refer to here as a bond spread, it's a pretty simple calculation. The spread equals the default risk premium plus the liquidity premium. So the bonds of large, strong companies will have very small liquidity premiums. Bonds of small companies often have some pretty high liquidity premiums, maybe as high as 2%. So let's see how we can work this through some numbers, right? So here we have Moody's has, with their different bond ratings, and we want to look at the percentage of default. So if you look at a AAA rated bond, 1-year bonds default 0.13%. Within 5 years, it's 0.68%. So less than 1% of all AAA rated bonds on average default within these 5 years. AA, again, zeros. We can see very low numbers It doesn't really start to concern us much until we get below these investment grade bonds. Double B bonds, within 5 years, about 6% of those bonds will default. So, you have a 94% chance that it's good, but there's that 60% chance of default. When you think about the spread, then it's the difference between the corporate debt, these AAA on down, and the 10-year bond, being at 1.72% in this example. AAA rated bonds were paying 2.2, the 10-year was 1.7. The difference between those two is the 0.49. So again, what is the spread? The spread is the combination of the default risk premium and the liquidity premium. As you go down, when you get to the CCs, the triple C's, 8.7% is the yield. That means about 6.65% is this spread that represents the chance of default and the ability to buy or sell these bonds pretty quickly, the liquidity. So what factors ultimately affect this default risk in bond ratings? I mean, how can we analyze what this is? We can look at some financial ratios, and that's what we'll do here in the next several slides. Certainly, debt ratio, right? How much debt does the company have? That certainly will affect default risk. The more debt you have, the more chance things will go south and you may default. Coverage ratios. Based on business operations, do you produce enough profits to cover the interest payments and et cetera for maintaining this debt? Profitabilities are going to have an influence also. Likewise, the current ratios, your management of your current assets, all of these things are going to have an influence on default risk. So let's see how that fits. So if you think about return on capital or debt on capital, either one of these, they just represent solvency, or how much return, or return on capital is the profitability, debt to capital is solvency. So what you'll see here, AAA rated bonds are the highest rated, highest quality. So what we can see here, this is the profitability column, and this is solvency. And as you would suspect, the higher quality, those bonds with the least chance of default should be the most profitable companies, or should be the companies that also have the least amount of debt. So you can see the actual ratio, right? The return on capital ratio is much higher for AAA, much lower for CCC, and of course vice versa. So again, we can find in these ratios that they are reflective of decisions and the outcomes of the company that ultimately could provide some insight into the companies defaulting on their debt. So what are these factors? Are there other factors? Well, you think about just provisions in the contract, right? Secured versus unsecured. Unsecured debt doesn't have any collateral. A little bit more likely that it would default. Senior versus junior, subordinated debt. Subordinated debt is more risky. If there are any kinds of guarantee provisions, that could affect ratings. Sinking fund, the debt maturity itself. But there are other factors. These really have something more to do with the company, right? What's the stability of the company? How do they react with regulations? And is there product liability that we have to worry about? A lot of factors go into this idea of bond ratings. Bond ratings, again, merely look at and try to establish a level of risk associated with the chance of default. So So let's take a break from this for a second and talk about interest rates and interest rate risk. Sometimes the terms are a little confused, right? So interest rate risk has two components. Price risk refers to the changes in prices when interest rates change. This is a very quick change. As soon as interest rates change, prices change. As rates increase, prices fall. Happens very, very quickly. This is the kind of interest rate risk that we always talk about when you are talking about how interest rates affect bonds. But there is another effect, right? Reinvestment rate risk refers to the changes in returns that you would get on future reinvested coupons. Now, this takes time, right? We have to wait for the coupons to get here to see how future interest rates will affect them. As interest rates increase, these future cash returns are also going to increase. So if you look at these two examples, if interest rates rise, prices fall. That's negative. If interest rates increase, future cash flows increase. That's a positive. So whenever interest rates change, there are two things that happen to bonds every single time. One very quickly, one very slowly. But they have opposite signs, if you will. So what is reinvestment risk? Well, think about this. If you won $500,000 in a lottery, you want to invest that money and live off the interest. If you buy a 1-year bond with a yield to maturity of 10%, in year one, you'd get $50,000. So at the end of the year, you get back your $500,000 to reinvest. What if interest rates now fall to 3%? That's going to drop your cash flow from $50,000 to $15,000. Now, had you bought 30-year bonds, your income would have remained constant. So this is what reinvestment risk is all about. Now, we would like to be able to manage this. It's a little bit beyond this course, but we would like to be able to manage this through some hedging activities. So maturity risk premium, again, is time. The longer the time, the higher investors want to be paid, or the more investors want to be paid for delaying their use of their money. So long-term bonds have high interest rate risk. They have low reinvestment rate risk. Short-term bonds, low interest rate risk, high reinvestment rate risk. So there's nothing as riskless. There's risk everywhere. So the yields on longer-term bonds usually greater than shorter-term bonds. So this maturity risk premium is more affected by interest rate than it is by this reinvestment rate risk. If you look at the yield curve, we can see how this is built. The real rate is down here. It is stable. Now the inflation premium, it will change based on time. So the longer the time frame, the greater the inflation premium. Now it could be fairly flat or it could be fairly steep, depends on economic times. And then of course at the top, as the maturity extends outward, we would expect this maturity risk premium to add to the return that investors would like to see. So again, I want to kind of finish this discussion on bonds. So let's first talk about bankruptcy. There are two kinds of bankruptcy that corporations are concerned with. Chapter 11 is called reorganization. Chapter 11. Chapter 7 is liquidation. Companies would prefer Chapter 11. Creditors want Chapter 7, right? So Chapter 11 means we just revise the company. We reorganize the debt. So we'll work with a trustee to help or supervise this reorganization. Management typically stays in control of the company, but we will rework the financing plans with these companies. So maybe we would extend the debt a certain number of years. Maybe we would decrease interest rates for a couple of years. But essentially, the company has to say, "Look, we're worth more alive than dead, right? There's more value here. We're struggling right now. If we thought we were not worth more alive than dead, then the judge would order liquidation. We would sell all the assets and then pay off all of our debts, and the company would go out of existence." So how can we predict bankruptcy, right? There is some studies that were done by Edward Altman, did this back in actually I think it was the early 50s, mid 50s maybe, when Altman started this. He used something called discriminant analysis. It's similar to regressions. And basically it creates a formula. This formula uses financial ratios to describe whether a company is more or less likely to enter bankruptcy. Now, we looked at some ratios early, profitability, and we looked at the solvency ratios, and you can see there is a relationship with the default risk. So these formulas can help us predict what happens in a company. So think about how many applications a bank might receive on a monthly basis. I mean, companies like maybe like PNC. I mean, in the entire corporation, I would imagine they get thousands of loan applications from businesses. Well, do they need to go through all of those files, all of that data, to determine whether or not the company should get a loan or not? Well, what they can do is they can use this Altman process, and it will help predict bankruptcy. So here's how the formula works. Down below, here is the formula. It's referred to as a Z-score. So you take 3.3 and multiply it by EBIT divided by total assets. That's our basic earning power ratio. 0.99 times total assets divided by sales, total asset turnover ratio. 0.6 times the market value of stock plus the preferred stock divided by total liabilities. This is just a variation of a financial leverage multiplier. 1.2 times working capital divided by total assets, looks at short-term things. And then 1.4 times retained earnings divided by total assets, which just represents just a reinvestment of owners' money into the assets of the company. So the general rule is, if the score is above 2.99, the company is not likely to enter bankruptcy. If it's below 1.8, there's a high risk of bankruptcy. Anything between 1.8 and 2.7, still there's a good chance of bankruptcy in the next 2 years. So if a company is between 2.7 and 3, this is the gray area, right? We might say, look, anybody less than 2.7 does not get a loan. Anybody above 2.99 automatically just gets the loan. So we do this formula quite quickly, calculate the number, and we figure out it's either rejected, accepted, or we're going to look a little bit closer. So maybe we can narrow this down to maybe 50 or 60 loans that we need to really investigate to see if the company should is sound enough for debt. So here we have two companies, Coca-Cola and Molson Coors. And if you look over the past 5 years, you can see that the Z-score for Coca-Cola is well above the 3 range. Very little chance of bankruptcy for Coca-Cola. But what about Molson Coors? We've got some challenges with Molson Coors. We know that they have some current asset problems. Their their profitability, basic earning power is fairly low. Their turnover ratio is fairly low. Their market equity to total debt, again, it's less than 1. So what we're finding here is that the management and certainly the creditors for Molson Coors are very concerned about this low number. So they're going to worry about this, and they're going to try to find ways to increase the numbers so that they can have be more creditworthy. Should they need debt, they want to be able to borrow, and they want to be able to get a good rate. So, in essence, on an individual side, they need to find a way to increase their FICO score. So this is sort of like a FICO score. The lower the number, the less likely you're going to be able to make payments. So how this ultimately works then is if the company goes bankrupt and we liquidate the asset, where does the money go? And there is a payment priority. What you'll see is at the bottom are equity holders, preferred and common are at the very bottom. This line, everybody here stands in line. So if for some reason, let's say we have wages and unpaid benefits, right? So if for some reason our employees don't get paid, well, they have a right. They're in line here to get paid. So what happens if we don't have enough money to pay them? Then they then become an unsecured creditor with everybody else. So again, payments are made in this order. As long as there's money left off, it goes to the next line. And in the end, if there's any money left over, it goes to our common shareholders. So in a liquidation, unsecured creditors generally don't get any money. This makes them more willing to participate in reorganizations. Various groups of creditors vote on the plan. So if both the majority of the creditors and the judge approves, the company emerges from bankruptcy with lower debts, reduced interest charges, and a chance for success. So the reorganization is what everybody wants. There are actually things called bankruptcy plans, where basically it is a preset plan that you basically kind of use as your template. This is the plan we're going to use. If everybody votes on that, quite simply, it happens very quickly. So again, that's enough on the bond and interest rate risk analysis. Look forward to talk to you soon. Bye-bye.